Hello and welcome to my channel, The Quality Investor. What a week we just had in the markets. There was a lot of mixed sentiment as some companies like Amazon and Meta soared and other companies like Google and UPS fell pretty hard. Today, however, I am discussing Microchip Technology, ticker MCHP. This chip stock is a staple of the analog semiconductor industry. They produce microprocessors and microcontrollers used in everyday electronic products like garage door openers. They released their earnings on Thursday after the bell and opened Friday with a 3% loss before ping-ponging throughout the day and settling with a 1.5% loss. This continued a trend of the broader semiconductor industry and signaled that we may not quite be at the bottom of this semiconductor down cycle. Like Texas Instruments, lower demand for their products and underutilization of their fabs was a major theme of the earnings call. In my opinion, there were some positives to take away from this earnings release as well. So let's get into the earnings. But first, if you enjoy content like this, please like and share this video and subscribe to the channel. Also, hit that notification bell so you can know right away when I post more stock analysis content. Looking at the results summary, we can see right away that they did not have an impressive quarter. Revenue declined 21.7% sequentially and was down 18.6% year over year. We also saw major margin contraction. You can see the gross margin is down to 63.8%, which is nearly 350 basis points off what their trailing 12 is at 67.3%. Operating margin is even worse, down to 41.2%, 540 basis points off their trailing 12 at 46.6%. All of this is disconcerting. At first glance, you have to question the fundamentals. These are large drops. Margin contraction especially is a red flag. We have to ask why though. This is why understanding the business and the industry it operates in is so important. As a chip stock, Microchip Technology operates in the notoriously cyclical semiconductor industry. We are clearly in the trough, and the CEO indicated we will see continued weakness here through mid-2024. This is very similar to what Texas Instruments signaled on their call. Also in a similar vein to Texas Instruments, Microchip cited weak demand for their products due to customers trying to unload their current high inventories. They are seeing their backlog shrink. One thing to watch for in the next earnings is an increasing order backlog. That will signal we may be in the upswing. While one reason for the margin contraction was the weaker sales, another point Microchip stressed was their factory underutilization. They are not running at full capacity and are even planning a 2-week shutdown this quarter. That's another negative for margins. However, as you can see on this chart here, they've come out of each of the semiconductor industry down cycles a little stronger than they were before. However, there is one positive I took away from this call that tells me this is short term, and we will see growth sometime within the year. The CEO stated that the revenue decline was because of volume decline and not pricing decline. This is important. Microchip has not and does not need to reduce prices to drive sales. This means they are keeping their competitive advantage in regard to their product quality. Like I said earlier, once their customers' inventories clear, in other words, demand increases again, Microchip will rebound nicely. They also discussed their future plans for free cash flow on the call. As you can see here, they are down from last year as well as the 9 months ended in December, and their margins are off by quite a bit. However, on the call, Microchip stated that they plan on returning 100% of free cash flow to shareholders by Q1 of calendar year 2025. They plan on doing this by increasing dividends first and then through share repurchases if the stock dips enough, though they didn't provide a number. They also raised their dividend to 45 cents this quarter, which is up 25% year over year. My takeaway is they are committed to growing the dividend and are doing share buybacks wisely, meaning they buy back shares when they believe the stock is significantly below their intrinsic value. As you can see on Microchip's shares outstanding chart here, you can see the shares have gradually increased. However, there are periods when they have share repurchases, meaning they're only buying back that stock when they believe that share price is at a fair price. So what does this mean for Microchip's updated valuation? Let's start with the growth rates I'm using for my projection. My year one numbers here are in line, actually on the low end of what management has provided for guidance. And you can see there is a fairly significant revenue decline, as well as margin decline. The rest of the projections here are fairly in line with what analysts are projecting. And my revenue is at a 4.35% compound annual growth rate for the next 10 years, whereas my free cash flow is compounding to 7.5% over the next 10 years. You can see that that's very much below what their 10-year historical averages are, meaning I'm being very conservative here. And you have to keep that in mind when we see the final numbers. Also, this is what management provided for their guidance in the shareholder presentation along with the earnings. I wanted to point out these operating margins here. Their long-term model is stating at 44 to 46%. I wanted to point that out because I want to show you what I'm using for my model. So I'm using their numbers as the initial guide here, and I took that 44% and I knocked it down to about 42% for my 10-year projection here. So margin is expanding to 42% over the next 10 years, whereas net income margin I have expanding to about 33% over the next 10 years. So again, I want to stress that I'm trying to be as conservative as possible here with these numbers. So coming over to the final valuation here, I want to stress that I'm essentially using my bear case. And we saw that was about a 4.3% growth annually for revenue. So my discounted cash flow price, that came in at $121.20. Also for dividend growth, I'm projecting 12% annually over the next few years, which is well below what they just increased their dividend by. And that came in at $126.65. That is with a 6.5% perpetual growth rate for the bear case on the dividend model as well. For the exit multiple, that's at $85.27. So why is that so much lower? So the comps I'm using for my exit multiples are Texas Instruments, Analog Devices, NXP Semiconductors, STM Microelectronics, and On Semiconductor. And you can see the average PE is out to 18.74, which is pretty much in line with what Microchip's current PE is as well. So that really speaks to the broader weakness in the entire semiconductor industry. So the PEs right now are at pretty historical lows. You can see here, the trailing 12 PE for Microchip's at 18.5. Look at their 5 and 10-year average, 52.5 and 54. The forward PE is at 22.7, well below their 5 and 10-year averages as well. So the exit multiple is actually being dragged down by the broader weakness in the semiconductor industry. And with that slight decline, about 1.5% yesterday in the markets, we're now at $84.29. The valuation average comes to $113.58. That's a pretty phenomenal upside considering how conservative my growth rates really are. That's an upside of 34.75%. Using a 20% margin of safety, that gives us an acceptable buy price of $90.86. That is in fact pretty much in line with my previous valuation from last quarter. I said buying up to about $90 is where we want to be for Microchip. I've said many times on this channel that free cash flow is one of the most important metrics for any investor to look at. Share price typically follows free cash flow growth over the life of an investment. So looking here at the free cash flow for Microchip, you can see just the phenomenal growth over the last 10 years of their free cash flow. They don't have a huge CapEx spend either, so they're really generating a lot of cash for investors. I believe this is the main reason for a positive valuation in an otherwise pretty bearish earnings report. The bottom line is Microchip generates cash, and my projections are growing at least half of what they've been doing historically. At the moment, the semiconductor industry as a whole is working through that trough of the down cycle, and it will return to growth in the near future. As always, I want to remind everyone that this is not financial advice, and I do own a stake in Microchip technology. Also, please hit that like button and don't forget to share this video. And if you found this content useful, consider subscribing to the channel and joining our community. Thank you and happy investing.